All right, everyone. Welcome again to the Faces of Business. I'm your host, Damon Pistolka. And with me today, I've got Tyler Jefcoat from SellerAccount. Tyler, welcome.
Thanks, Damon. I appreciate you having me today, man.
Oh, man, I am excited. Because you work in the world of e-commerce and you work with numbers. So that's my world.
Yeah, we're like strange kindred spirits from across the country here, right?
So. Yeah. Only I went to school for engineering, which has nothing to do with accounting. But the thing that's cool, man, is that you're helping e-commerce companies solve the accounting challenge. And I think when we look at e-commerce, the accounting challenges for e-commerce and the solutions, it's always interesting to talk to an expert like you that is in there doing it.
Well, thank you, man. Thank you. Yeah, I mean, we talked about this for a second in the past, but the data sets coming out of these e-commerce platforms, marketplaces, sales channels are just complex and hairy enough that something like 99.9% of accountants in the world hate it, right? They want to avoid it like a fiery passion, and that's all we do at SellerAccount. We decided let's just niche in here. It's funny, you're talking about engineering and now you're kind of in the M&A, helping people exit space. The first company I built was a healthcare company. So I'm an accountant with a finance MBA that decided let's build a healthcare company. Exited that a few years ago, and then started this brand, SellerAccount. And I'm kind of back home where I've actually have some ability to add more value than go help that person. So it's been a good pivot back into my education, honestly.
Well, let's just talk about that a little bit. Tell us about your background. I mean, you got an interesting background. You built a company, sold a company, but just give us some history here and then how you kind of ended up doing what you're doing today.
Yes, I mean the quick story is I'm here in Georgia. The other was it UGA, the Harvard of the SEC or something like that. It's actually not true, but studied accounting. I was not a traditional accountant. I like people a lot more than your traditional accountant does, and ended up joining a startup to build a home healthcare model. A few years, I went back to grad school and kind of launched it out of the MBA program at Georgia. And we had a good run, 0 to, about 100 employees in about 4 years. And man, it was more than I wanted to manage as a CEO. I was not, I was outside of my gift blend because I'm more of a visionary sales guy. And what we really needed in that company was a manager, somebody who could hold people's feet to the fire. And so we sold the company, and it has since, I found out last year, Damon, sold again to a national franchise. So the concept that we built from scratch, literally we had a focus group of 30 people in a room that helped us build the brand and the essence of our company. That concept is now officially gone from birth to death. It doesn't exist anymore. And so it's kind of an interesting moment. So I sold that company into 2017, started SellerAccount because I'm an e-commerce junkie. I was kind of a scrappy eBay seller guy even when I was in college. I hate to say it. I'm not proud of this, but Bezos does control my life. I get everything on Amazon, right? And so building a company that kind of niches into e-commerce was pretty natural. I don't know much else, so we did finance.
Yeah. Huh. That's cool. So are your sellers primarily somebody that's going to be on an Amazon only platform, or are they on multiple platforms?
No, yeah. So it's for us, the niche is e-commerce. So for the clients, they're going to choose to pay for kind of a higher level of accounting are normally not your kind of old school retail arbitrage sellers. We're normally having some connection to the brand, whether it's private label or we may even have some manufacturing shops, Damon, like some of your clients do.
Yeah.
And beyond that, it's not that there's zero bricks and mortar. Some of our clients do have some traditional wholesale accounts, but that's not the bread and butter of their business. Our core customer is, has an Amazon or other marketplace strategy, maybe Walmart, Wayfair, and the like. And then they also have a clear direct-to-consumer strategy executed through Shopify, WooCommerce, and that kind of thing.
Okay. So they are on your clients are on multiple platforms.
That's right.
Trying to hit everybody everywhere.
Yeah, and that's kind of the challenge, right? Is how do you manage your precious resources to know how many buckets should I stick my feet into, right? I mean, I think that's really been an interesting challenge for especially the CFO clients. So the half of our business that I'm most involved in is really kind of a CFO advisory service for these brands. Yeah. And and it's interesting because Amazon is an entirely different animal than Shopify, right? The funnel's different, the expenses are different, profitability is different, and some products are never going to make it on a Shopify site. Doesn't
Yeah.
matter how good you are at advertising. And some products are never going to make you any money on Amazon because the fee structure is too high. And so just understanding your product market mix and kind of having a coherent, I think it's something I've heard you say even before, Damon, is having a coherent strategy for your catalog is kind of is paramount. You got to have that. And so that's kind of one of our roles, is to help our clients develop and implement that strategy.
Yeah. Well, I tell you, the e-commerce space, I'll just call it that, in the last 18 months has gone through so many changes because of, the COVID-induced buying frenzy, for lack of a better term, on just about every e-commerce seller that, is not selling something that, isn't in demand, which I'm sure there are things, but not very many, because just about everything else I can think of that is sold with e-commerce has been in high demand. And, it's nuts. Everything from, new companies popping up to valuations on buying companies to all kinds of things. So just overall, what are some of the interesting things you've seen, or some challenges you've seen in your work in the last year?
Yeah, so thinking about it from the brand's perspective, you're exactly right. I would say 80% of our customers had a great 2020 because of the COVID bump. We saw a macro acceleration towards e-commerce buyer behavior. That's one way to say it. In other words, grandma used to go to Kohl's. Kohl's was harder to get to. She finally bit the bullet and set up that Amazon account, or finally had the guts to put her credit card into a website. And so the adoption that was already happening, that the curve was already heading in the e-commerce direction, we probably saw 3 or 4 years worth of acceleration in that curve last year for a lot of our brands. But you mentioned this, the other 20% of the brands had a really terrible year, right? They were selling something related to travel. In fact, I was on a phone call with
there you go.
Yeah, something like, I was on a call with a guy earlier, multi-million-dollar brand, really nice set of products. He's not gone. He's in good shape. But boy, did he take it on the chin last year, because he's selling products that are often purchased in preparation for business travel or something of that effect. And so what's really interesting, I don't know if you've seen this also, Damon, but now that we're on the back end, I'm not saying we're on the back end of the pandemic, but we're on the back end of the main noisiness. The clients that had the best summer in 2020 are seeing a de-escalation in their growth. There was almost an anti-COVID bump that happened here in July, where I would say half of my clients had a pretty poor month last month. So we're sitting here talking here in August, and it's because of two reasons they had a poor month. And this is to kind of get to your question about challenges. One is we were arbitrarily inflated last July, and we needed to come back down to earth. There's a little bit of that.
Yeah.
And then the second thing is getting a damn container out of China right now is 3 times what it would have costed my clients a year ago. And so those products are just flowing through to their P&Ls now, right? So all of a sudden you get to July, and that container that used to cost me $8,000 cost me $22,000. That's finally hitting my profit and loss, and is creating some compression in margins, for the most recent months.
You're right. And I had someone on, I don't know, last week or the week before, or a couple weeks ago, that was talking about that very thing, container costs from China, just like you said, and they're in Georgia too. It was like 8,000 to 20,000 or some darn thing like that. It was just like, man, it's just mind-boggling, because when you look at, and that's just container cost, right? So when you look at it, if I have $100,000 or $200,000, even $200,000 worth of product in that container, that's still, I just added a lot of percent points onto my cost of my product.
Yep.
And you can't just go out across the board on everything and raise prices.
Yeah, you're exactly right. The elasticity for our customers, the downstream customers, never seems to match what. Actually, you mind if I show you a quick illustration I found?
No, let's see it. Let's see it.
Right, you guys are going to love this. So let me see if I can.
Pretty sure you can share
screen. Let's do this one. Okay. So
I'm going to put it in, and we'll see it now. There we go.
It is. Okay. So I just went, this is just a Google search. I wanted to take a minute and let's have a pause. Bezos's wealth over the last 12 months only increased by 4%, which results in about $8 billion. He may not be able to feed his children. Things are really hard for him right now. You see how he underperformed the S&P 500 by a pretty large margin. But I don't know if you ever heard of these guys here. Let me get over here. Have you ever heard of these guys right here?
Yeah,
These guys had a very good year.
Oh my goodness.
So the same chart here where you're looking at poor Bezos down there at the bottom, the S&P, which had a 32.5% year, and now you've got Maersk that is more than doubled over the last 12 months. So do you think they've actually had their cost go up? I don't think so. I think they were able to gouge the system here a little bit. But I just I'll show you some other stuff here in a little bit. But I thought that was so interesting. Those guys are they're winning. And here's what they got to be careful of, by the way. If I'm Maersk, I got to be a little bit careful because Bezos does have a track record of like retaliatory vertical integration.
Yeah. And that's someone that's got enough money to do it.
Right. You know, it was spaceships, it was trucks. Next thing you know, they already have ships. It's not like Amazon doesn't already have freight ships. But you might be surprised over the next 2 years to see all of a sudden Amazon has bought 17 additional container ships or that kind of thing. I mean, So
well, I mean, they're ensuring their long-term success by making sure up and downstream that they control it, if nothing else. And even if they don't eventually own it one day, they'll have a lot of if they start it and do that, they're going to be owning it.
Yeah, that's right.
So that's good. But container costs, they're hitting them now. We're seeing a lull in July, but are your clients generally optimistic about the outlook?
Yeah, I think so. There's a little bit of trepidation. I don't know if you've seen this with your customers, Damon, but so just from an exit standpoint, because out of our portfolio, we've had, I think, close to 10 of our clients be acquired in the last year. Lots of cash flooding into the space with the aggregator funds and that kind of thing. And a few of these clients have had just slam dunk, very high multiple, obscene kind of exits, really, 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 really nice exits. And a few of those are still happening. But there is a little bit of rising concern because of not just the supply chain pressure that I mentioned, but also some pressure on advertising has just compressed margins a little bit. And so we've seen a little bit more of the, kind of $1 to $20 million brand owners saying, okay, I either need to exit now or I'm going to probably wait 9 months and try to get through another Q4 and try to see if the supply chain can normalize for me a little bit. Because I'm a little worried I'm going to get whipped if I go to market right now because the smart money is trying to get smarter. I'm not sure that much of it was very smart a year ago. It was just throwing cash at portfolios. So that's the other thing I'm seeing is I think there is a time, everyone's for the most part bullish. Amazon's not going anywhere. Shopify is for sure not going anywhere. But I think if there's never been a golder time to sell, that may have been 2 months ago, or maybe in 6 months, like maybe right at the beginning of the year. And unless you happen to be one of the favored brands that really saw double-digit plus growth still even through July and August, and then there's so much money that's clamoring for your brand. If that's you, that you may want to consider going a little bit more quickly.
That is a good point, and I think you're right that it was going so hot for the end of 2020 and into 2021 that the money rushed in. And I mean, how many places now, if you go to several of these aggregators, they're still saying, hey, we'll buy your business in 60 days or 90 days. And they've got it worked out to bing, bang, boom. If you're that right size and especially if you got a few products, multi-million-dollar brand on FBA, that's it's a no-brainer for them anymore.
Yeah, it's kind of changed the strategy a little bit. I mean, Damon, if you and I were talking 18 months ago, every strategist in the country would say, please diversify as quickly as possible. Yeah. Let's get off Amazon. Let's find ways to diversify. And then and here's my magic word, kind of as my number, a rule of thumb as a CFO was, let's try to get some other channel above 15%. Because then we are actually articulating a lowering of the risk profile when you go to market and try to sell this thing. But in the last 12 months, it's been completely cuckoo, Damon. It's like, if we can get 4 SKUs, each doing $1 million a year in revenue, only on Amazon.com. We want 2 VAs. We want no infrastructure. Please don't have a warehouse and partridge in a pear tree. Right? It's like just so simple, streamlined. That almost, first of all, it's exactly where the market is right now because these aggregator funds are private equity that doesn't know how to operate the business yet. And so they're having to do things that are as simple as possible. I think my concern, or maybe my advice to someone that isn't going to go to market right away is don't forget that common sense normally still catches up to the market, right? And
Yeah.
so
Yeah.
if you have more than a 6 to 12 month timeline, now might be a great opportunity to start investing in those other channels again and try to have an offering that's going to be more palatable for a bigger acquirer maybe in a few
Yeah.
years.
Yeah. Well, and you're right. I was really surprised when I started hearing a couple years ago now, when they started putting money into the aggregators, and then they really gained steam last year, like amazing steam. But that they would buy a company that is completely tied to Amazon. And, because in that respect, that goes against everything that the M&A industry has talked about for years, and private equity and investment. It's diversify your risk, diversify your customer base. I can't tell you how many deals I've been in, and they go, oh, too much customer risk because you've got, more than 50% in one customer.
Right.
And it's like, now it's just like threw caution to the wind on the Amazon platform.
Yeah, I mean, I think the private equity market has decided to trust Amazon's staying power. I think that's really what's happened over the last 18 months.
That's a good way to say it. Yeah.
And I think what everyone's waiting for right now, and you guys need to keep an eye on this over the next couple of months, is one of the larger aggregators, Thrasio, is likely to have some form of an IPO, probably with a SPAC here in the next 2 months.
Yep.
And I think how the public markets kind of respond to the full kimono financials of a firm like Thrasio is going to have a pretty significant impact on how much pucker versus additional private equity enters the space. So
yeah,
there was another firm, I think they changed their name. It was Mohawk. Maybe they became Tyrion. That really got crushed last month because they were a public company that didn't earn what they had forecasted. And so I think Thrasio is much, much healthier than that company. But we're all kind of waiting here saying, okay, is another 6, 10, $20 billion in capital going to flood the space? If Thrasio gets treated like Cinderella next month, the answer is yes.
Yeah.
If Thrasio then in 3 months has to release a true Q3 earnings or whatever the case might be, and the public markets say, we don't buy this thesis that you can be very Amazon centric, we're going to see a lot of puckering happening. A lot of cash trying to figure out what they're going to do. And so anyway, for guys like you and me, it's just kind of like, wow, I'm just kind of excited to get to see what happens.
Yeah, no doubt about it. I mean, this space for me has been so interesting really for the past 5 years. But I think that the last, like you said, last year accelerated 3-4 years in 1 year. The buying, the types of buying, the way people are buying, the way companies are solving buying, making it easier for customers. I mean, just 5 years ago, you never thought about going to Home Depot, having your products ordered and pull up and just rolling it to your car or them bringing it out to you. Now how many people shop like that now? It's when you have to go.
Yeah, but I have gotten lazier. Like I don't feel great about this, but it's like so easy now to either just buy it on Amazon or be like, I mean, I'm able-bodied. I'm in my late 30s. It is not that hard for me to walk into Home Depot and buy the damn shovel, right? But like now I'm like, well, hell, they'll put it in my car for me. I mean, I guess I'll sit out here and listen to my podcast and let them do the work for me. I mean, to your point, Damon, it's amazing how quickly that buyer behavior. And so this is maybe my point to anyone who listens to this. That phenomenon isn't going away, right? The idea that buyer behavior is going to continue bending towards e-commerce, regardless of what might happen to Thrasio or Amazon or Maersk or anyone else, not going anywhere.
It's not changing. And I tell you what, the big box stores, and Home Depot is one of them, I think, that realize this and embrace this before 2020. They were starting this early, and a lot of other people had to catch up. But you're 100% right now. You think of the convenience that just that Home Depot, and for someone like me, where if I've got people working on my yard or my son when he's home from college, I got working on a project. I sit here and I'm like, boom, you got a project this afternoon. Just go pick up the stuff, and how good is that?
Yeah,
I mean, this kind of thing that we can do now. And I look at people that I know now. My mother's in her 70s, doesn't go to the grocery store anymore. She has it delivered. It's like, why? I don't need to go to the grocery store anymore. And part of it started because they didn't want the risk, but then now it's like, hey, we like this.
Yeah. Was it $5 for them to deliver it? Let's do
it. It's so crazy like that. Yeah. Or they do the drive up and they put the bags in your back, like in the back of the car like that. So this kind of stuff, I think, has driven a change in buying habits that have moved us so far ahead, like you said, 3, 4, 5 years ahead, that e-commerce to me is this playground, because now we're trying to figure out what crazy things can we add e-commerce to, and especially in the manufacturing and e-commerce world where I work a lot, where we're talking about being able to do things like, I just saw an article the other day, or not an article, but I was on Instagram and an ad popped up for a sheet metal fabrication company in, I think it was in Nevada.
Huh.
Send us your file with these specifications and we will give you an instant quote off of it.
Amazing.
So how the configurator like that understands what you're giving them, and a completed assembly, or completed component, they were going to give you a quote like that. These are things that we would have looked at years ago and just like, you're crazy, move on.
Yep.
But now the Amazon culture, and I shouldn't say Amazon culture, but the infiltration of Amazon into all of our lives has set the expectations like that for everything. And I think you're going to be looking at companies that are like, you just pick one, Merck, Smith and Nephew, medical companies, whatever companies you want to talk about, Caterpillar, it doesn't matter what it is. People are going to expect to be able to get on. I've got, 1,000 pieces of construction equipment, and the head maintenance buyer is going to expect to get on to Caterpillar and order every damn thing they want online and not talk to anybody, not go to a distributor, not do anything, and have it show up.
Yep. And then the step further becomes, then they're going to demand an API integration where it's just real time. And so, it's so interesting, Dan. It's, if you could somehow take a whiteboard, I got one behind me here, but like if we could take a whiteboard, and I would encourage you guys to do this for any products that you're manufacturing or private labeling or acquiring, is really plot each of the points in the value stream.
Yeah.
I think what you need to realize is that the pressure is for it to be a simpler, smaller supply chain where there are less middlemen, less stops on the value journey, and that there is pressure not only in consolidating the number of kind of squares in that flow chart, but in consolidating the speed with which that flow chart needs to be able to spin. So like theoretically, if I was manufacturing this old UGA cup here, I need to be thinking, okay, what are the actual stops? I have a freight forwarder, I've got a factory, I've got this, I've got this, I've got this. And I now have to be thinking 3 years in the future. Half of those middle entities aren't going to exist. Am I one of them? Because if I am, I need to do something different. I need to do it really quickly to pivot the way that I'm delivering my products so that I can accomplish, Damon, what you're talking about, where now we can use technology to order something that quickly and have it be maybe customized. And so it's going to be interesting to see. This is another part of it's going to be interesting, is to see if anyone else can figure out manufacturing the way China has. I mean, I've got guys that are working heavily in Vietnam and Laos, and I've even got some guys working heavily in Mexico right now. No one's figured it out yet, right? I mean, it's China's still king, and they're like 17 years ahead, it seems like. But I think in technology years, we're going to see some additional pressure to, whether it's 3D printing or whether it's something else, to make more of a, I mean, think about that Nevada company you're talking about, their ability to take what's probably a CNC router based steel cutting system and basically pull a software piece where they got a guy at a table who's like, here's the next one, it's round, let me cut it. Here's the next one, it's triangle, let me cut it. I mean, that's amazing.
Yeah. And it is. And when you think about it, you're exactly right. I think this is going to be the demand is faster, compressing that supply chain, and customization.
That's right.
And yes, there's always going to be some standard products, but when you look at companies, well, one here, we know kind of what this company comes from, where it comes from, and even they customize their stuff now. And these are the kind of things that I think people are going to want. And I think there's an opportunity here too. This is where domestic producers of more premium products can really stand out, because like that company I was talking about in Nevada, if they can instantly quote something and then produce it, say in 3 days, you can get it back out to somebody in say 7 days. Now we're talking, because I actually was talking with a client about this last week, and they're in an industry and have domestic production, that this would make a difference. And I said, what if you could customize color combinations, size, whatever it is that you're working on, and customize, someone's name on it or whatever you want to do, and do it in 3 days. Instead of this whole production being, okay, we want to get some volume on different kinds of products, blah, blah, blah. Mm-hmm. Let's figure out how to get volume, but let's figure out how to customize each one.
Right.
And what that does, the speed, the value of that speed. I mean, big companies have been doing it forever. And here in Seattle, we have PACCAR. They build semis, right? It's the semi trucks. Each one of them can be completely different from the one right behind it. You can do it if you figure it out.
Yep.
So when we can put these into more everyday products that are consumer based, or like you said, even B2B based, that's going to be something.
Yeah, be really cool. I think that's probably where things are headed. I think you're exactly right.
Yeah. But like you said, it's going to there's going to be people in the middle, I think, that are going to get squeezed out from it. But what else are you seeing that's interesting, man? Because you're off to talk to, where are you going to be talking at? You said you're talking like this week at?
Well, so there's a conference coming up in a few weeks called Resonate. They're going virtual this year. So I was live in Vegas a couple months ago at Prosper, but this is Resonate's a good show. It used to be live in Atlanta. Now we're going to be doing remote. And then I'm speaking, you and I do the same thing, tour the masterminds and the podcast, and just try to figure out. So I guess a couple of interesting, I'll do them one at a time in case we run out of time. If we run out of time, we can look at it later. But here is.
All right, I'll put her back on screen here.
All right, so SellerAccount is trying to do a better job of keeping up with, kind of what's happening in data sets across e-commerce. So taking you go to a conference, you go to a cocktail party, everyone wants to talk about their sales. Sales are vanity. What are they really doing in terms of profitability? And I'm an accountant, so this illustration's awful, but I wanted to show you what Q1 profitability looked like relative to Q2. And the top left-hand corner, the kind of darker brown, that's the profit. That's PAG, post-advertising gross profit. So as a CFO in the space, what I really care about is how can I have my after ad? So I'm thinking about cost of goods sold, logistics, marketplace or merchant fees, and then my advertising. What is the contribution margin of my portfolio?
Yeah.
And that's the circle, the red circle. I want it to be as high as possible. And then everything else that might be on my P&L is just overhead. I want to keep it as low as possible, right? That's the game. And so just stopping at that PAG line, post-advertising gross profit, you can see that we had a better Q1 than Q2. And the differences are obvious. That tripling of the containers I talked about a few minutes ago is finally starting to hit those P&Ls. And so we saw the landed cost of goods sold factor just go up by about 5 points. Wow. Across a pretty large set of data. So I thought that was pretty interesting. What do you do about it? I think what you do about it is you hold tight, because I think the container logjam is going to come on log jammed here in the next few months. I think you're going to have to spend more on advertising. I think you're probably going to have to accept a slightly lower margin for a few months. Q4 is going to be great. But just if you felt like July was kind of crap, you weren't the only one. So I just wanted to mention that. And really even before July, kind of in May going into June. The next thing I wanted to show you is this. This is like the way that a lot of, at least Amazon sellers, are feeling now with like this aggregator phenomenon. We feel like we're playing against the Superman version of us all of a sudden. Like, how are we going to compete with them?
Yeah.
And I guess I just want to make you feel a little better for a second. So I'm just going to skip a slide here. This is the most recent quarter. And what I thought was so interesting is that the left-hand side over here, all of us are actually still performing a little bit better than the aggregators. So it's close. We tend to be a little bit more efficient with our advertising. They haven't quite figured out how to advertise at scale yet. And we tend to be a little bit more efficient with our logistics because we're leaner operations.
Yeah.
And yet, if you were to look at the actual P&Ls for the aggregators, you're going to see a bottom line profitability of like 20 points because they don't have any overhead. They're able to slather that huge overhead across 100 million in sales. And that's why you're going to continue to see more of this happening more and more and more, is that there are some real economies of scale in being, you mentioned Home Depot. Being Home Depot has its perks, right?
Oh yeah.
So,
Yeah.
so anyway, I thought that was one thing I wanted to share. But do you have any comments or questions about that?
No, I think that's awesome because people are listening might get, like you said, you get intimidated by, okay, now these 5 brands that I know and may even be friends of yours, because a lot of people know each other in the industry, right? So they got bought by these aggregators, and we used to be, friendly competitors. Now I'm competing against a behemoth, and I'm not ready to go yet. All right, for whatever reason, it's great to understand that. And I think too, as you said, I don't know if it might have been before we got on, we were talking about the aggregators. I think the aggregators honestly are going to find that they've spent a lot of money that maybe they shouldn't in a rush to invest. And that because of the fact that there's nobody that can deny that e-commerce has had a very nice run for the last 12 plus months. And a lot of these deals have got done in the last 12 months. And we'll see what the long-term play on some of these brands really is.
It really is interesting that those two phenomenon collided. It was because COVID accelerated e-commerce that the private equity world decided that this was a worthy venture. At the same time, you're exactly right in that there was a bit of a gold rush mentality, and still is really, where I think, and this is something you can speak to for your clients, very few of these e-commerce based deals have actually gotten paid all the way yet, right? Most of them have an earn out, stability. They need these guys to execute for another 24 months in order for them to get all of their money. And I think you're right. I think it's going to be, but here's what it's going to mean. I do think there's still some advantages to first movers. So a lot of the early guys are going to do well. Purge, Heyday, Thrasio, and the like. I think they're going to do pretty well. But then there's going to be a bunch of these medium small funds that are already trying to find a Thrasio to buy them, already trying to find a Heyday to buy them, because they realized actually running these businesses is a lot harder than I thought it was going to be. And so I don't know. It will be interesting to see what happens over the next few months.
Yeah, definitely will. But I think that it's great to get your perspective on it, because there's a lot of, and like most industries, most businesses, business owners tend to get up in the morning and look in the mirror and make decisions. That's who they really talk to a lot of times. And it's great to get to hear your perspective on that. Awesome. Well, what else you got for us today, man? Like I said, you're talking to an engineer. I love hearing this stuff. So what else we got going on?
All right, let me give you one more kind of nugget here. This is going to be pretty actionable for our audience here. So I think if I were a $10 million brand right now, I'm going to really start focusing a little bit more on PAG, which I'll talk about a little bit, and on another metric called return on working capital, which I'll show you in a second. And I'm going to start focusing a little bit less on other vanity metrics like just sales growth or just cost of goods sold. And so if you look at this small case study, Amy and Brian both have brands. They're both $1 million a year in sales. They have the same cost structure for landing their product. Amy actually is a little bit less efficient in terms of her advertising and Amazon fees or whatever. It doesn't have to be Amazon. Maybe it's logistics. Maybe she has a piece of furniture. Maybe it's just harder to ship. Whatever it is, her profit margins after ads are 20%, whereas Brian is 30%. The last 18 months has seen Brian, at least in the beginning, Brian was getting a higher valuation than Amy because Brian is more profitable. It makes sense. His profit margins are heavier. What we're starting to see, though, and I hope this slide shows up okay here, is the investors are getting smarter. They're realizing that the amount of net working capital that I have to have tied up in this business asset actually matters a lot. And so when you look at the fact that on average over the course of a year, Amy has about a quarter of the inventory, which means she has to borrow a quarter of the money or invest her precious cash. And so now what you're doing is you're taking annual profit for Amy, 200,000, divided by, I only had to put 75,000 chips on the table. And as a result, my return, 200,000 divided by 75,000 is 2.67. It means for every dollar I beg, borrow, steal, put in the business, I'm getting a benefit of 267 a year.
Yeah.
Whereas Brian, who appears more profitable at first, is having to keep 4 times the inventory in his supply chain. And I'm not talking about units, I'm talking about dollars. He probably has worse terms with his suppliers. He probably has a broader catalog of 50 different products when maybe Amy has 4. I don't know what the actual difference is, but my argument, and something that you guys should start looking at, is that Amy's business is 2.5 times better. And not only that, Brian's business is 2.5 times riskier than Amy's, because the amount of capital that he has to risk is so much higher. Does that resonate? Does that make sense, Damon?
Oh, it does. And actually, one of our larger clients that we were working with a few years ago, this exact thing came up because as the company grew, the owners were not able to keep the return on working capital the same. And it should have been, honestly, should have been. And it was because of logistical challenges. But the inventory grew at a much faster rate than it should have. And when they look at the working capital, it's all part of it.
Yeah.
And that's a big deal when especially when you're doing, 20, 30, $40 million deals, because that's a lot more money that they have to put down over the term to run the business. Yeah.
So a couple of things here. One is in both of these scenarios, you've got to have decent books, right? So obviously I said bookkeeping, but you have to be able to answer these 2 questions. How much profit did I actually make on an accrual basis over some amount of time? And the second question is, how much inventory did it actually take me to generate that profit? You got to be able to put your hands on those 2 variables. And then the second thing I'll mention here is, if Amy was my CFO client, like I'm coaching Amy, I would say, Amy, your velocity is unbelievable. You're turning your inventory 4 times a year. I'm happy. This is great. Let's take the next quarter and focus on your advertising campaigns and on your assets that are going to help you get better return on ad spend, because your margins are a little bit low. Whereas, and so this is for you guys that are watching this, if I'm Brian and I've got low velocity, then I'm going to say, Brian, PPC is doing great, buddy. You've got great margins on your products. I need you to get more at bats per year. Right now, you only get 1 at bat per year with every dollar you borrow. I need you to get more. And there's a couple of ways you might be able to get more. Obviously, renegotiating your supply chain. Guys, for every week you can get your supplier to wait for you to pay them is 7 full days worth of your cash cycle that you get to keep.
Yeah.
And so finding ways to restructure debt, finding ways to make sure you've got the right 3PLs in place and I think you were saying this earlier, I think some of your prior episodes have been about supply chain. It matters. Identify what's broken in your supply chain. And you might be able to, if you're Brian, take a business that's kind of underperforming and turn it around pretty quickly by making 8 or 9 phone calls, that kind of thing. Yeah.
Yeah, you're right. And that supply chain, especially if you're someone that's importing products from China, there are a myriad of ways to adjust that, to take that number from where you were looking at it from a 1 to maybe even a 2, just with some adjustment.
That's right.
And doing what you're doing and coordinating, and because it is a challenge. I mean, if you've got just say you've got 100 containers worth of product that's in flow any given time, a day of the year, it's a challenge to make sure that there's not you didn't just get 20 of them. Right. When you should only got 5, and especially when you figure and combat it with today. Now it's even worse because they're sitting in the water now and they're just stacking up on the other side. Well, a lot of that they want to get paid for. That's sitting in the water, which is even worse because I can't even sell it if I want to. But those kind of herky jerks that happens. I mean, they're not 50,000 herky jerks. This is like $750,000 hits. And you didn't know. And you're like, well, we knew it was on the water, but we didn't, whatever happened, and it just hits all at once. It's like these kind of cash flow challenges, again, drives up the cost of running that business. And like you said, the ways that you can adjust that are many, and you have to look at it. The buyers are getting smarter. It's the same thing with selling a business 30 years ago, 25 years ago. And I wasn't in it. I'm old as hell, but I wasn't doing it then. So when you look at that, people didn't have the data that they have today about valuation of business. It's simple things like this that become common knowledge over time. And, every buyer is going to get smarter as it goes on. And as business owners, we've got to get better at running these businesses.
Agreed.
Yeah. That's so cool, man. I'm glad you showed that and talked about it, because it is something, especially, and I mean, when you look at it, $1 million brand, it's a fair amount of money, it's a fair amount of product, but there's a lot of $1 million brands on Amazon.
Yeah.
And if the $1 million brands would do like you just said, look at where I'm really at and make the changes I need to, it could make a significant difference.
Really good. And for bonus credit, I think if they did that same math problem per product line, so what was the profit for my product divided by how much of that product I have to have tied up my capital in? And then just kind of, I hate to say it, it's a bit of a survival of the fittest. Which products in my catalog are killing me right now? And those are going to have to be on probation for 90 days. And if they can't fix it, I'm going to have to cut them. And so I think as a brand manager that's dealing with the realities of our current supply chain and e-commerce environment, you have got to up your game when it comes to managing the catalog level, which is kind of what I showed you, and then the product level of your return on capital.
Yeah. Yeah. You make a great point. The catalog, and it's not adding to the catalog, because everybody loves to add to the catalog, right? But taking it out, it's always like we can add new products like crazy, but let's take the ones out that aren't performing. Yeah. And then just see what they are, or even for that matter, figuring out where they could perform. I mean, because I look at, and this is, I don't want to get too far off on a tangent, but oftentimes if I'm running a multi-category brand, I am really strong in one category. Right. And I know, because that's where I started. I know my pricing in that. And while I moved into an ancillary category that's pretty good, just take something like backyard stuff, right? Yep. Home outdoor furniture, right? You just do that. There's all these different pieces. Well, I might have been really good at the table and chair setup or something like that, but now I'm going to make couches, or I'm going to make whatever it is. And it's really good at, I know the margin on this, and well, we're just going to apply that margin over to this other product line, but that may be more competitive, less competitive. And really they miss out on sales because they go, well, it's not our normal margins and it's not selling, so it's no good. But maybe they needed to get a little more competitive. Maybe they needed to change the way, there's just so many other things that could make those products good. And then it sits there and just languishes.
Yeah, I think that's right. I mean, almost every business I've ever worked with has at least one SKU that is killing them. And if you have enough good SKUs, you ignore it to your own peril. And so I think that point is extremely well said. I mean, there's a reason that Procter & Gamble has a separate brand management team for each of the brands, right? Because they have to specifically understand who the avatar of the buyer, what does she look like? What does she prefer? And I'm going to build my value offering, my pricing, my supply chain, my marketing strategy, everything around the customer. But to your point, I've had so many brands exactly like you just said, Damon, where they really figured out this customer, but they also like had a cat and wanted to make a cat product. And then next thing you know, they're much, much less efficient at the second product than they were at the first. And again, it doesn't mean you don't expand. Just be ready to invest in understanding your segment a little bit better so you can be successful.
Yeah. Good stuff. Well, man, I enjoy talking to you, because it's a geek out on this stuff, but you're such a good source of knowledge for the industry, and where people can really learn from what you're saying. So any last thoughts that, the people that are looking at their e-commerce and going, man, my accounting is sure a mess. What are some things that tips you could give them?
I mean, I think if you can't answer the question within maybe 10 minutes of pulling up your accounting system, how much money did I actually make last month versus the month prior, then I think at a bare minimum, it's time to take a second look at your books. Now, if this is a hobby, if you're doing $10,000 a month in sales, treat it like a hobby. But as soon as it becomes a business, biggest errors are the ones you guys have all heard of. Don't run your personal expenses through the business. Make sure it's clean and separate. At some point, are you still there, Damon?
Yes, I am.
Oh, yes, cool. Video froze up. I'm like,
okay.
But, make sure that you've got, a dedicated credit card, and just do the work to make sure that you can put a name on every dollar. I hate to say you could hire a bookkeeper. Obviously, we do bookkeeping for e-commerce. We'd love to help you, but I think putting a name on every dollar, and then as you get closer to that 100,000 a month mark, it's time to implement a pretty decent inventory management, cost of goods sold system that may require you to get an expert involved. And that's another area where we could potentially help you. But I just think it's one of those things. Listen, I'm a sales guy. I have an accounting degree. My MBA is in finance, but I'm fundamentally a people person. I don't like looking at spreadsheets all day long. Thank God my business partner and the team do. I think if I can force myself as an entrepreneur, I'm optimistic. The grass is always going to be greener tomorrow. If I can force myself to spend 1 hour a week taking a deep dive look at my finances and forcing myself to follow the data and make choices based on the data, instead of kind of being like, it's probably fine, I'll check it later. If you'll just give an hour a week, I think you'll see significant improvement. And here's a great example of this. This is just for my business, right? I'm for the first time now, 3.5 years into this business, measuring our sales funnel. Never did it before. Like, how many leads actually come into the website? How many of those book a call? How many convert to a client? And I was like, we got 2 rungs in this value chain that are broken. I would have never known that. I would have never been able to take action on fixing that for my company until I could see it. And so I think for you, making sure you can see your numbers so that you can drive the ship better is kind of what
it's funny you say that, because one of the first things we usually do with our clients is we implement a weekly performance dashboard where it's super simple. But listen, we want to know the gross margin every week, and I want to know how my channels performed to the gross margin line. Yeah. And it is so good just to get that, and then make sure you're, like you said, make sure you can figure out how you are on a monthly basis or whatever. But measuring that performance and taking that hour every week will make a big difference.
Agreed.
Yeah, awesome. Well, Tyler, if someone wants to get a hold of you, what's the best way to do that?
So Seller Accountant, and kind of see it behind me, which way is it? Here it is. SellerAccountant.com, SellerAccountant.com. You can find us there. Nice. Any way you want to get a hold of us, you can do it through the website. And Damon, thank you so much for having me, man. This has been great.
Oh, it is awesome. I'm so excited about it. Just being able to talk to you about it. And then you just blew it out of the water with the graphs and the information. Just thanks so much.
Hey, you're welcome, my friend.
All right, everyone. Thanks for listening. Thanks for joining us again for another Faces of Business. Hey, this week on Thursday, it's funny that we were talking about the things we were talking about, because on Thursday we have Christina Harrington from Gen Alpha, and what they do is they've got an e-commerce system that's made to put on OEM manufacturers to help through the entire supply chain take out the catalogs at the distributors and repairs. It's going to be fun. And we're going to talk about that. So thanks everyone for joining us. We'll be back again on Thursday.